The stock market can seem like a complex puzzle. Investors are always looking for tools to help them make sense of it all. One such tool is the price-to-earnings ratio, often called the PE ratio. This ratio is a fundamental indicator of how much investors are willing to pay for every dollar of a company's earnings. Understanding the PE ratio can give you valuable insights into a company's stock valuation and potential future performance. The PE ratio is widely used by investors, both novice and experienced. It is a measure of how expensive a stock is relative to its earnings. A high PE ratio suggests that investors are optimistic about the company's future growth prospects. Conversely, a low PE ratio might indicate that investors are less confident in the company's future earnings potential. The PE ratio is a valuable tool for comparing different stocks within the same industry or across different sectors. Calculating the PE ratio is a straightforward process. You simply divide the current market price of a company's stock by its earnings per share, or EPS. EPS represents the company's net income divided by the number of outstanding shares. For example, if a company's stock is trading at $50 per share, and its EPS is $5, then its PE ratio is 10. 50 divided by 5 equals 10. The PE ratio provides a snapshot of how much investors are willing to pay for each dollar of a company's earnings. A PE ratio of 10 means that investors are willing to pay $10 for every $1 of earnings generated by the company. It is important to note that the PE ratio is just one of many factors to consider when evaluating a stock. Other factors such as the company's financial health, management team, and industry outlook should also be taken into account. High PE ratios generally indicate that investors are optimistic about a company's future growth prospects. They are willing to pay a premium for the stock because they expect earnings to increase significantly in the future. For example, technology companies often have high PE ratios because they are perceived as having significant growth potential. Investors are willing to pay more for their earnings today in anticipation of higher earnings in the future. Conversely, low PE ratios might suggest that investors are less confident in a company's future earnings potential. These companies may be in mature industries with limited growth opportunities. Investors are not willing to pay a premium for their earnings because they do not expect significant growth. However, low PE ratios can also be misleading. Sometimes companies with low PE ratios are undervalued by the market and represent good investment opportunities. While the PE ratio is a useful tool, it is important to use it with caution. One limitation is that it does not account for a company's debt. A company with a high debt load may appear undervalued based on its PE ratio, but its high debt levels could pose significant risks. Additionally, the PE ratio is based on historical earnings, which may not be indicative of future performance. Before making any investment decisions, it is crucial to conduct thorough research. Consider the company's financial health, industry outlook, and management team. Consult with a financial advisor if needed. Remember that the PE ratio is just one piece of the puzzle when it comes to stock analysis. By using it in conjunction with other financial indicators and a comprehensive understanding of the company, you can make more informed investment decisions.